Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for February 20th, 2024. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. And we have a very, very special guest this morning, friend of the family, friend of the show. We have Bill Cassidy joining us from Journal of Commerce. Morning, guys.
Good morning.
Good morning.
Good.
What instrument is that over your shoulder? Is that some kind of mandolin?
That is a bouzouki. It's a Greek bouzouki. Yes.
Huh.
Yes.
Is it played like a mandolin?
It's played something like a mandolin or banjo, but I had to confess I don't actually play it. It belonged to a friend of mine.
Nice. I have all my guitars hanging on my wall, and I probably haven't played in 10 years. I used to play all the time as a kid, but they look cool hanging on the wall, so I get where you're coming from. Bill, you want to give folks less familiar a quick intro on what you've been up to over the years and kind of your role in the freight ecosystem?
Sure. I'm senior editor for trucking at the Journal of Commerce, and I've been doing that since 2009. Before that, I've been a journalist covering transportation and trucking since 1984. Started out with a magazine called Fleet Owner, which was published by McGraw-Hill back in the day, and worked for Transport Topics and for a magazine called Traffic World for several years. And that led me to the position I'm in now, where I write about trucking, both LTL and truckload, private fleet, write about third-party logistics, write about technology to an extent. Basically, everything from, what's going on with companies in the industry to, economics and how it ties into the international transport scene.
Awesome.
And I live in Alexandria, Virginia.
Nice. Well, thank you for joining us. It's a pleasure to have you. We're going to jump into our content so that we can bring you back as quickly as possible for what I'm sure will be a great discussion for the second half of the show. So let me get straight into our key points of the week. So spot rates dropped for the third straight week. We're now below 2019 levels. I think for those that have been through this before, they weren't head faked out by the weather-driven events of late January, and they knew that, or at least had a pretty good idea that rates were going to come back down, which they did. The MSU for higher trucking ton mile index is flat in December, up 2% year over year and 1% versus 18. Housing starts dropped 15% month over month as construction slows. That's kind of typical for this time of year. Interest rates have also crept back up a little bit, which I'm assuming has a part to do with that as well. And then truckload capacity continues to rebalance to meet lower demand levels. Last I checked, some of those attrition numbers were slowing, but still not edging as close as we'd like towards positive territory. Something I'm sure Dean will fill us in on, and something definitely to track over the coming months. So with that, I will turn the reins over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. We'll do a quick market update this morning so we can get to Bill a little bit later. The long-form version of today's report will be published this evening. Just go to dat.com/market update. So let's start off with dry van load to truck ratio. Load post down for the fourth consecutive week. Familiar theme here across all three equipment types. You're starting to see some of the lowest load to truck ratios in 7 or 8 years. Some of the lowest volumes we've seen in the spot market for week 7 so far. Load post down last week, down about 21%, down about 61% lower than last year. Load to truck ratio dropped to 1.21 loads per truck in dry van. In refrigerated, very similar story, down for the fourth consecutive week. Load post volumes are also about 60% lower than last year. It's impacted, of course, a lot by the lower volumes of produce moving nationally, a lot of which moves on the spot market. And carrier equipment posts were down also last week. That was somewhat of a surprise. Normally equipment posts go up when volumes go down. Load to truck ratio in refrigerator 1.94, and in flatbed the load to truck ratio was 6.62, down slightly last week. Load post volumes are sitting about 59% lower than last year. Looking at a couple of our markets, in particular the top 5 markets in California, Georgia, Illinois, New Jersey, and Texas, the average line haul rate, excluding fuel, in the top 5 markets was at $1.72 per mile last week. That's identical to what it was in 2019. The average of the top 5 states was down 4 cents a mile last week. Illinois had the most significant weekly increase, dropped 10 cents a mile to $2.12, about 5 cents a mile lower than 2019. And California outbound spot rates have been down for about the last 6 weeks straight, averaging $1.84. And in refrigerated, California, we're having a look at that this week. It's the forerunner of the national truckload produce market. Spot rates have been down for about the 6th week, averaging 208. Compared to 2019, outbound California reefer rates are 4 cents a mile lower than in 2019. Fresno, one of the largest produce states in the market, outbound rates are down about 4% last week, averaging $1.71, even though volumes were up 6% last week. And in flatbed, a lot of activity going on in Texas. It's one of our biggest markets for flatbed carriers. Inbound volumes are up about 2% year over year. Outbound volumes are about 4% lower. So we're seeing a little bit of excess capacity impacting rates. Inbound flatbed rates are about $2 a mile. And on the busy lane that we track, kind of a bellwether for the flatbed market, Houston to Fort Worth, carriers were averaging $2.17 a mile last week. That's the lowest in 12 months, of course, partly driven by the excess capacity on higher inbound volumes. And wrapping up with our year-over-year look at spot rates, following the mid-January national freeze, the average dry van run haul rate dropped by 12 cents a mile last week. Dropped by 12 cents a mile following last week's 4 cents a mile decrease. That's from mid-February, down 12 from mid-Feb. At $1.63 a mile, line haul rates are 13 cents a mile lower than this time last year and just 1 cent per mile lower than 2019. And in refrigeration market, national average reefer rates dropped for the 4th week. Last week, they were down 6 cents a mile. It's 2 weeks they've been dropping at 6 cents. At $1.94, reefer line haul rates are below $2 a mile for the first time since mid-December, decreasing by 20 cents a mile in the last month. And lastly, in flatbed, rates decreased for the 3rd week. Not big decreases. They've been holding fairly well up until now, down 2 cents a mile last week. At $1.97, the national average flatbed rate is about 13 cents a mile lower than last year and about 9 cents a mile lower than in 2018, a great year for flatbed carriers, as Bill will walk us through later, and about the same as in 2019. That's it for this week's market update. Remember, dat.com/market update for the long form version of today's report, including all of the charts and commentary. Back to you, Ken, for the short-term forecast.
The historical model, our flagship Raycast, is the best source of data. Going to refrigerated, a similar story here, although Raycast does have rates coming up a little bit this week, heading into maybe the first half of next before falling back down to pre-peak levels. There's some choppiness this time of year with protect from freeze and just different weather patterns that can happen that affect refrigerated freight. So something to keep an eye on. Turning last to our most consistent forecast, which is flatbed, you start to see the country digging out of some of its seasonal hole here as we start to get into the first week or two of March. Ratecast a little less optimistic. The other 3 forecasts much more optimistic heading into the tail half of March. So with that, we'll bring everyone back and get to our question of the week.
Yeah, thanks, Ken. So, Bill, we've been chatting about the truckload market for a couple of years now, and I'm just fascinated with this new index you've built because it explains a lot of what's happening in the broader market, particularly large truckload contract capacity. Last week, you wrote a fantastic article, and one of the quotes that you made was you were seeing the steepest drop in large truckload carrier capacity this cycle. What do you think's behind that? Maybe give folks a little bit of a sense of what this index is measuring.
Sure. Well, before we get to that question directly, let me do a little bit of a level set with some explanation of the index, if that's all right. The truckload capacity index, I started this index initially to measure a recovery in capacity following the Great Recession, because we know that capacity tumbled at that time, obviously. And I based this on fourth quarter 2006 truck counts at a group of large publicly owned truckload carriers with like billions and billions of combined revenue per year, and then moved it forward going through the last decade. Had to adjust it a few times because of acquisitions, but basically we're looking at truck counts at the end of the quarter as a measure of capacity. And what we've seen over the years was, one, capacity began to drop among these carriers before the Great Recession and continued to drop after the Great Recession right through early 2013, before then turning up again and going through these, what we almost would see as a normal up and down, right into the pandemic. And big increase in the pandemic, followed by now a big decrease. What the big decrease says to me right now, Ken, we've been hearing a lot from trucking executives at these companies. And, we all know them, and, they're the large publicly owned truckload carriers. They've been looking for the past 2 years for a market inversion or an inflection point based on the exit of smaller carriers from the market. And the confounding thing to them is that really hasn't happened at the rate they expected it to. What the index tells me is that they're not just sitting around waiting for that to happen. These carriers have made some significant cuts in their own capacity, whether voluntarily or involuntarily, to kind of meet the market conditions, to face the current market conditions. And Derek Leathers from Werner said it very well in the recent earnings call. He said they're trying to lower cost in order to execute. So they're trying to lower their cost in order to basically meet the current shipper demand and execute, based on that demand. So the index dropped from a high of 93.2 in the second quarter of 2022, which you all remember was when the market seemed to turn pretty quickly. We saw the Russian invasion of Ukraine, the impact on fuel and all the rest. It dropped from that 93.2 reading to 80.8 in the fourth quarter of last year. And that was down from 83.2 in the previous quarter, third quarter. So that was actually that was a 2.4 percentage point drop. That was the biggest drop since the third quarter of 2022. It was the biggest drop that we've had actually in this, except for the first quarter of 2023 in this whole period that we're looking at.
Right.
I mean, that's kind of what you'd expect, right? I mean, that's always good when an index mirrors what your lived reality is, right?
Exactly. I mean, if we had seen, an unusual increase, it would have really, been a mind boggler. But no, it has kind of tracked what we would expect. And it's just, to me, it's really interesting that it has, come down that far, that fast. But then again, it rose up. It's now come down farther than it rose from 2020 through 2022 to its peak. So, it came down a little bit faster than it rose, but we did have that huge increase during the pandemic, followed by an almost matching decrease down to 2018 levels.
Yeah, Bill, it's interesting. Jason Miller's truckload ton mile index that came out in December has the TTMI for those 41 freight generating commodities, slightly above 2018 levels and 2019 levels. It's rather interesting. I think that we're starting to rebalance back to those levels, which back at the time, 2018 was considered, some were saying it was an outlier. It was not a good representative year of the truckload market. Turns out it was actually probably one of the best years we could benchmark the current freight cycle to. Would you concur with that?
Yeah, and it is interesting because I look back at this index, and so it was 80.2 in the first quarter of 2018. It's 80.8 in the fourth quarter of 2023. Before 2018, it had gone to 80. It had risen to 80 by the first quarter of 2016. Now, remember, 2016, 2017 was a down cycle. So it dropped into the 70s before rising back into the 80s in 2018. And by the end of 2018, it looked pretty strong, and it dropped slightly in 2019. Of course, 2020, in the second and third quarter, some of the worst of the pandemic, it was down around 82, 83, and then it bounced back, and we saw the big growth in the pandemic in 2021, 2022. So the cycles are quite clear in this, but yeah, it does make 2018 look like, right now things seem weak, and the capacity level you think would be worse, but it does tell us that it's at a level that wouldn't have been considered, too loose or too low in the past.
Yeah. Bill, a couple of questions.
Becomes tomorrow's trough.
Right. A couple of things. One is maybe explain why you index this to 100% in the fourth quarter of 2006. That would be a good place to start. And the second part of the question is, this includes dedicated and one-way for higher capacity also, correct?
Right. It does include dedicated and one-way. I don't split those out, and it's very difficult in some cases to split those out. The reason it's tied to 2006 fourth quarter, again, I started this back around 2010, and I was trying to track the recovery from the Great Recession. And 2005 had been a boom year for trucking, much like 2021, 2018, 2014 were. And I wanted to get the previous peak, or a good example of when truck counts at these carriers had kind of peaked before beginning to decrease. And so I picked the fourth quarter of 2006. And that, it's a combined, I take the combined truck counts, and we then build the reading based on that as the base. That equals 100. And yeah, it's very interesting in that, it did continue to drop right through 2013, which defied my expectations. I thought back in 2010 that we would see a build up back to where we were, but we've never really gotten back to where we were among these carriers. And again, these are the large contract carriers for the most part, not as much spot market exposure among most of them. And, some of them actually did build up above where they were in 2006. Landstar, I think, is the prime example there. But Landstar now has pulled back its owner-operator capacity, I think 18% since its peak in 2021. So yeah, there's a lot of diversity within this group. And, sometimes some of them are going in one direction and others in another. But overall, they give the impression that, these large contract carriers did, after the Great Recession, rein in their capacity and redirect probably their assets toward freight that was more profitable to them, leaving more opportunity for smaller companies to grow into that space.
Bill, Jason Millimer had a great post. I'm not sure how long ago it was, but he was talking about I think it was 2013, 2014 freight cycle, and how long that trough was. One of the themes he's been talking about a lot is the trough that we're in. which I think is a great way to describe the current market. Can you maybe describe for our listeners what that 2013-14 period looked like, and maybe strike some comparisons with the current cycle?
Yeah, I think there are, some interesting comparisons between these down cycles, as we could call them. 2013, 2012, 2013, a lot of the headlines were about, are we heading into a double dip recession? What is this a soft patch? These were terms that were in the news every week during that period.
Right.
And, frankly, we had an industrial downturn at that time. We had, consumer demand was there, but was not growing in the way that, perhaps it had grown in the previous decades cycles. So when you look at that and you look at where we are now, we've had, how many quarters of an industrial downturn in this down cycle, going back to 2022, late 2021, maybe. Hopefully we're beginning to come out of that, lift out of that. But there's always a need for a catalyst. And my big question is, what's the catalyst going to be this time? In 2013, going into 2014, we had a big increase in energy production and fracking in particular. And that really helped the freight market. A lot of flatbed freight, but also a lot of other freight. And, you look at the market today and we don't have that as a catalyst, but, what might emerge is the next question.
Yeah. One of the other things in your article that caught my attention, and part of the reason I asked about dedicated, you were talking about the improvements in truck utilization, trucks running more miles on better engineered routes. How big of a factor do you think that is in this rebalancing of large truckload capacity? Because the number of trucks at both, some of the large carriers, if we listen to Derek's last earnings call, their percentage of trucks in dedicated, I think, was up to 63% or thereabouts of their total fleet.
Yeah, and they mentioned that they're not afraid to go to 70. In fact, that's where they want to head. And it's gotten to the point where Werner sees its one-way operation as a farm for the dedicated operation. And I thought that was fascinating because that's a complete flip from the way things used to be, where dedicated was kind of a side niche. It was your side hustle in a way. Back in the days when irregular route, 48 state, one-way truckload was the norm. So what this says to me, and it's been something that we've been discussing and tracking for several years. I mean, the largest carriers in the country have, over the past decade, really thought about what types of freight they are going to pursue, what gives them the steadiest volume of business, and what gives them the best return. What is the most profitable mix of freight for them. And increasingly, they have shifted towards dedicated contract carriage, whether it is, Werner is a prime example, but, JB Hunt, of course, Schneider, they're all moving closer to that business. And it's a business that gives them, longer contracts, better rates, closer relations with their customers, greater insight and reach into their customers' business than they would have in a more transactional one-way, or even, a contractual one-way environment. So it's a very broad and well thought out transition, I think. And again, these companies, their bread and butter is hauling high volumes of freight under contract for very large shippers. And, the question is, why haven't they returned to the capacity level in terms of truck count that we saw, back before the Great Recession? And I think a good part of that must be, there was a decision of sorts that we're going to pursue this market. Anybody who wants to pursue the other market, have at it.
Right. Right.
We're not going to add capacity back just to pursue that same business we were pursuing back in 2005 or 2001. And that's where we've seen this very strong growth in small carriers and owner operators, from the Great Recession through the pandemic.
It could also be driven by the large fleets meeting drivers where they're at, right? Because dedicated's a great retention recruiting strategy for fleets.
Right.
I worked at one of those large carriers in a previous role, and I was kind of shocked that we'd gone through the transformation from one way to dedicated by looking at customer lane density, and normally people think dedicated, they think drivers are back home every night, you're slip seating the trucks every 12 hours. Well, in this particular operation, dedicated actually meant you're out all week. So it wasn't dissimilar to the duration of time you were out in truckload. But what happened was they were meeting drivers where they're at that wanted a better work-life balance, wanted to be home more often. Dedicated affords you that. And of course, drivers love familiarity and consistency. So it's actually a very good retention strategy, but it's not necessarily just one-day trips. There's a lot of regional work that goes on in dedicated. So I think that could be part of it also, is meeting drivers, an ever-changing driver demographic that has a desire to be home more often, which of course is not necessarily consistent with long-distance trucking.
Yeah. And I think it's also the case that a lot of the smaller carriers, obviously they're not just pursuing freight on the spot market. They're also, working in some type of dedicated arrangement with the smaller shipper. Many smaller shippers can't get the attention of the larger truckload carriers because they don't have the volume. So who do they go to? They go to the people with, 10 to 100 trucks who will say, I can have someone at your dock every week, twice a week, or 3 times a week if you need it.
Got it.
So I think there's a lot of that shift going on too, which is more dedicated like, even if it's not a dedicated contract.
Yeah.
Bill, so we're having the best month in a while in terms of Class 8 net carrier counts. When do you think that number will eventually turn positive? It's been negative since October of 22.
Wow.
We always put people on the spot on this show, and I figured this was a good one to put you on the spot.
Yeah, that's a good one because I don't have a good answer for you. So I am on the spot. When will the count turn positive? You think we're taking in terms of retail sales for Class 8 or?
No, so we track net authorities.
Net authorities.
Interstate, with the exception of intrastate for Texas and California.
Okay. I think my answer for everything this year is going to be 2025. And maybe later in 2024, depending on how freight demand changes.
Right.
But it just seems that with the number one, we still have a huge number of carriers in existence today. Whether they're hauling freight or not is another question. But just in terms of the numbers of operating authorities, registrations, and all that, it's still way up from where it was in 2019. So we had this huge influx of companies during the gold rush, and now that we're in the bust, they've been going up, but they've been going up more slowly than anyone expected. So the large carriers who thought that, by now we would have seen capacity tighten enough to create an inflection point and send the market back up and inflationary again. It just hasn't happened yet. So this bottom that you've been tracking and measuring just seems to be stretching out further and further. And where we thought we would see a rebound in many cases, many people said we'll see a rebound in late 2023. Now it's looking more like mid 2024, late 2024, depending on numerous factors, maybe even 2025. So I think there's still probably enough of a surplus out there that we'll see continued attrition. But I think there's also a large number of companies that have been able to hold on and who are still out there, even in what look like pretty dismal market conditions for smaller companies. that I think has changed the picture, from previous cycles. I think, and Dean and I talked about this. Maybe Dean, I'll let you take over. But previous cycles we saw, I think the number of exits was more rapid, and it may be because, number one, we had a smaller number of carriers, smaller band of carriers leaving and going to begin with, but also companies didn't have the opportunity to amass as much reserve in the boom as they did during the pandemic years.
Yeah.
So
exactly it. Yep.
Well, Dean, we're running up on time here. You want to bring us home?
Yeah, all right. A couple of quick shout outs. I'm on Radio Nemo with Jimmy Mack, Road Dog Radio on Sirius this Thursday, 8 a.m. Eastern. Chris Kaplis's podcast is out this week, the Freight Vine podcast. Anne-Marie Yonkman from Blue Yonder is on this week's edition, talking about supply chain software, how it's evolved over 8 years or over the recent years, and the growing role of AI. Next week's show, Saritha Willingham from SJW Logistics in Atlanta will be on our show talking about the state of logistics in the Southeast. Also, mark your diaries, announced this week, Road Check Week. May 14 to 16 is the current plan. And with that, back to you, Ken, to wrap up the show.
All right, Bill, how can folks get a hold of you if they want to pick your brain or read your content?
Hey, they can always reach out to me at bill.cassidy@spglobal.com. S&P Global is the parent company of the Journal of Commerce. And they can find me online at joc.com. Those are the two best ways to get a hold of me.
Awesome. Well, thank you, Bill, for joining us. I want to thank everyone for tuning in. We will be back next Tuesday at 10 a.m. Eastern. Have a good day, everybody.
Okay.
Thank you.